Now that the interest rates have started going up, when is this going to end? That is one of the crazy questions that I just got from one of my clients. Now I say crazy, not because they're crazy, but crazy because you know what? We don't have a crystal ball. But what I am going to do is break down some of the information as to why I've come up with what my thoughts are on mortgage rates and share with you what my take is going to be. My name is Jason Beatty. I'm your realtor with eXp Realty because your move matters. And if you would like to regularly receive information like this on what's happening in the real estate market, what is happening in the neighborhoods and markets, as well as hot new properties, etc., that are on the market, just like and subscribe, and we'll make sure that gets out to you. So now let's head on over. So to begin with, what we're looking at is we have seen some rates increase, okay? The Bank of Canada has started increasing their rates. Now, why is this occurring? I'm going to give you a little bit of history on what happens. We're just going to spend a quick minute on that, and then we'll go in a little deeper with what I'm expecting to have happen. So basically, I apologize. We're going to go to the Bank of Canada first. So Bank of Canada on April 13th had just increased the rates by 50 basis points. Basically, every 100 basis points is 1%. So just trying to simplify it there for you. If we look at the Bank of Canada's press release from April 13th, the Bank of Canada today increased its target for the overnight rate to 1%. Okay, with the bank rate at 1.25% and the deposit rate at 1%. The bank is now ending reinvesting and will begin quantitative tightening effective April 25th. Maturing Government of Canada bonds on the bank's balance sheet will no longer be replaced, and as a result, the size of the balance sheet will decline over time. Now, why is that important? Well, because what we're seeing right now is we're seeing the Bank of Canada rate has changed, has gone up 50 basis points, but that can affect the variable rate. Generally, doesn't directly affect the fixed rates, the 5-year fixed or anything like that. So what we're going to do is we're going to look at why those fixed rates might be changing. And actually, the Bank of Canada just suggested here what they're going to do is they're going to stop buying the bonds, and this is going to affect the bond market. So now let's see how that works. So basically, if we go to the Bank of Canada website once again, and we look at how asset purchases can also encourage spending. So this is what they had posted when they were looking at quantitative easing, when they were trying to keep the interest rates low. So basically what they're suggesting is, here's how it works. When the Bank of Canada buys bonds, this raises the price of the bonds and lowers their return or yield. Lower yields make it cheaper to access credit, meaning credit is cheaper. Now, this encourages households and businesses to borrow so they can spend and invest. So what the government tried to do is encourage us spending through the whole COVID, everything going on. The reason why was because they needed to keep money in the economy. So they kept the interest rates low, excessively low, very, very low, and this allowed people to borrow more money for buying houses, for credit cards, etc. Now, when we, being the government of Canada, okay, they buy, or the Bank of Canada, sorry, buy Government of Canada bonds, this is called quantitative easing, or QE for short. In the article that was released that we had just read, the Bank of Canada acknowledged that they were going to stop buying bonds. Now, quantitative easing can encourage spending. If we just read a little lower here, quantitative easing can encourage spending and investments by households and businesses in a few different ways. So, for example, if our purchases lowered the yield of a 5-year government bond, this would reflect in lower interest rates of 5-year fixed rate mortgages. And that makes it cheaper to borrow to buy houses. So basically, they're telling you right there that if they purchase these bonds at a lower yield, then that brings down the 5-year rate. Well, on the previous page, they've said they're stopping to buy these bonds. To me, that's suggesting that we're going to see an increase in this 5-year rate as well. Now, to understand what that means for you is if the interest rate goes up 1%, that takes away 10% of our buying power. And so I will get into that here shortly and just give you an example. Now, if we go, or as we go to woa.ca, they just sort of broke down what happened here on that first page, the press release. So the target overnight rate increased by 0.5 point to 1%. The inflation of 5.7% is at a 30-year high and at a level not seen since 1991. This is part of the reason why we're going to see excessive rate increases, in my mind, to try and get in front of inflation. Where are we seeing inflation? You're seeing it at the pump. You're paying more for chicken, for toilet paper. You're paying more for everyday essentials. Now, they're acknowledging here that it is expected to further increase to around 6%, and it currently remains well above the Bank of Canada's 2% target. So the Bank of Canada really likes to have the inflation rate hover around 2%. We are now 6% or 5.5%, heading to 6 and more. So now you can appreciate why there's going to be some very aggressive changes in the lending rates. Now, the spotlight now turns to the Bank of Canada's balance sheet. This is where they're going to talk about quantitative tightening. So it's set to begin April 25th. They have stopped buying the bonds, which we just talked about. The Bank of Canada acknowledged that. Now, if we go right to a source, the Canadian Mortgage Trends magazine, what they're doing is they're going to give us a little overview here. So March inflation of 6.7% sends Bank of Canada rate hike expectations even higher. So inflation continued to heat up in March, raising market expectations for future Bank of Canada rate hikes. Okay, we've just spoken about that. Headline consumer price inflation topped an annual rate of 6.7% last month, up from the 5%, and above expectations of the 6.1%, according to the data at StatsCan. Now, this is the highest reading since 1991. The largest price gains were in energy, gasoline, and food, right? Some of these items that we use every single day. Every time you pay your heating bill, I'm sure you saw it. Every time you paid your electrical bill, I'm sure you saw it. We see it at the pump. Now, little blessed being in Alberta, we're not at that $2 a liter price point yet, but we're seeing it all over the country where they are excessively increasing the price of gas. It is going up, and they're up over $2 a liter. Now, the average of the bank's 3 preferred measures of underlying core inflation, which exclude volatile goods. Now that rose to 3.8% in March, up from 3.5%. So what they're saying is basically those 3 key indexes are what they're looking at. Now, following the release of the latest inflation figures, the bond market upped its rate hike expectations. So they're saying, you know what, we're expecting the rates to go up. This is the bond market itself. Now, they're expecting pricing of another 175 plus basis points in hikes between now and December 7th, when their Bank of Canada meeting is. The next Bank of Canada meeting is June 1st. And we're expecting rate hikes to occur by then. But they're suggesting, the bond market is actually suggesting that we're going to see up to another 1.75%, 175 basis points to occur by December 7th. So that would actually take the bank's benchmark rate of 2.7%, of 1% right now, up to 2.75%, and could result in a prime rate of 4.95%. Now, this is a level that we haven't seen since 2008. Now, the fact that inflation is running amok should drive a minimum 50 basis point hike that they forecasted for the next meeting in June, wrote the Scotia economist Derek Holt. Now, Holt went on to say, I had previously argued they should deliver a series of 3 50 basis point moves. There is even a solid case for the Bank of Canada to go up 0.75% all the way up to 1%, all in one shot. This forecaster has not been wrong so far in the last 6 months, I believe. And he's suggesting for us to get out in front of this, we really have to see one massive jump. Remember I said 1% increase means 10% less buying power. So that can definitely affect a lot of us. Holt argues that inflation could actually top 8% once Stats Canada adds used vehicle pricing into the CPI index, which is expected next month. So what they're wanting to do is see how used car pricing or added in to the factoring as to what the rate of inflation is. Now, we also know used car pricing has gone crazy in Canada and the States as well. And so this is where I'm thinking it may not just sit at that 6% that they were speaking of, or 6.7%. I'm wondering if we're not going to hit 8%. Now, the obstacle is that the Bank of Canada has been dragging it every step of the way, which is a big part of the reason behind how we got inflation numbers like they are, Holt said. Monetary policy tailored to current conditions should already be at neutral, if not above, given where inflation is and with full employment recovery. So he's saying, you know what, it's almost like we're chasing a ball down the hill. I don't know if you ever drop marbles on a driveway or something. As the marbles start going, we try and bend over to pick them up, and it's already rolled down. That's kind of what we're doing, but in the other direction. We're not getting in front of this. We're letting it almost roll out of control. Now, economists at National Bank of Canada believe the Bank of Canada will once again have to revise its inflation forecast higher in July. They also say it's not clear how the bank could justify not implementing another 50-point basis points hike in the June meeting. So they're saying in June 1st, they're expecting it to go up another 50 basis points at least. We'd go as far to say that a report like this argues for intermeeting action, just to try and get back in front of the expectation to the extent still possible. So what they're saying is don't even wait till June. Get in front of it now and let's have another hike now. That may be a way that they can get that 1% in by June, is if they have an intermeeting announcement. So that's not going to materialize in their view, but clearly today's report endorses urgent and aggressive action. Now, that's from the National Bank of Canada. They say, you know what, we don't think that they're going to get that aggressive, but they really believe that we have to. Now, while the National Bank of Canada economists don't agree with a market view of a policy rate above 3%, they do say the path to 2 to 2.5 clearly needs to be steeper. So what they're saying is that earlier we mentioned the 2.75% or 275 basis points. Bank of Canada or National Bank of Canada says, no, you know, we don't think 275.3 or higher. We don't really need to be there. We think we want to be somewhere between 2 and 2.5. So that still is an ability to be able to have a massive jump, especially if we want to get into this. Then they write 2% by July. With inflation this pervasive, such aggressive actions look increasingly warranted. So this is coming out of a mortgage trends website. Basically what they're doing is they're a go-to for many of the mortgage brokers to be able to go and stay current on the information that's there. So now if we're just going to see, okay, what's my take? I think we do need to have these aggressive rate increases. And it would surprise me if they don't jump 0.75 of a point. Now, the Bank of Canada does need to stay separate. They are separate entities from the Government of Canada. And so they're going to argue that politics don't influence them. It's hard to see with this how they can't want to aggressively get in front of it. And so we'll see how that runs. Even if we see 50 basis points happen in June and then 50 basis points happen in another 3 months, that's a 1% increase. That means that if you qualify for a $500,000 home today, in 6 months' time, you're going to qualify for a home that's $450,000. That can dramatically change the home that you're buying. So if you're thinking about buying a home this year, doing any kind of a move, be it upsize or downsize, feel free to reach out to me. You can actually go and book an appointment with me, 15minuteswithjason.com. We can have a quick little chat and go over just my take on your scenario. We're going to see if you're thinking of upsizing and you've grown out of your home, really now is the time. We're seeing strong market activity in that lower price range. There is some opportunities as you move up, and you're going to save a fortune in mortgage payments as well as what you qualify for. So once again, if you have any questions, reach out. I'm here to help. My name is Jason Beatty. I'm your realtor with eXp Realty, because your move matters. Please don't forget to subscribe and like.